Tokenization is a technology by which you create a digital representation of a financial asset to try to transfer money when the national banking system is not open to do that. The anticipated solution involves blockchain, which another word for that is distributed ledger technology. You have various clearing members of a clearinghouse, all part of a network. If you created a digital image of money, if there were an entity, the clearinghouse, if the entity were the authority over the blockchain, then the clearinghouse could transfer money not through the banking system, but through the blockchain from firms that owed money to the clearinghouse to firms that could receive money from the clearinghouse. The whole objective of doing that is to reduce the market and credit risk that's in the clearing system.
How can tokenization help with 24/7 trading, and what are some issues that came up in your panel?
Monday through Friday, clearinghouses all over the world, they flush their clearing systems by transferring cash, variation margin, from firms that have a debit balance to firms that have a credit balance. Well, that's pretty easy to do when the indigenous national banking systems are open. The challenge is there are now products traded on exchanges that don't want to trade Monday through Friday. They want to trade all the time. The first large category of products are the digital assets, crypto, if you will. Crypto doesn't know Saturday and Sunday. Crypto doesn't know Christmas. The people that trade digital assets don't stop. It happens all the time. And so if you get in that business, you have to figure out a way to collateralize the risk that is going to be inherent in the system when the banking systems are not open. The other markets that also don't stop are the prediction markets. Increasingly, organized derivatives exchanges have stepped into the prediction market space, because if they didn't, somebody else would. There's some very interesting legal reasons why the prediction markets have looked to the futures markets for legal certainty. But we're really focusing on how could you potentially transfer wealth when the non-traditional banking systems are not open to do so. And one way to do that is to create a digital image of a financial asset and put it on a network where everyone else that is on the network agrees to accept a digital image of a financial asset. Then it all works. Distributed ledger technology is really, really good at one thing. It's called title transfer. A good example is repo. Every day you have 30 QZIP numbers that title needs to be transferred from a primary dealer's treasury portfolio to the Vanguard Money Market Mutual Fund. Vanguard Money Market Mutual Fund wants to transfer cash to the primary dealer to finance their portfolio. Every day, the treasury securities go to the left, the money goes to the right. The following morning, it all goes back. It's brilliant at title transfer. The thought process is that if you extend the title transfer part to a distributed ledger, then you can just transfer wealth. Clearinghouse accepts initial margin assets for two reasons. One is to collateralize the credit and market risk of the clearing members whose trades they guarantee. But once every 10 or 15 years, a firm fails. They can't pay their debts. And so the clearinghouse is forced to liquidate the financial assets that they held. Distributed ledger is so good at title transfer, people forget, well, wait a minute. Once every 10 or 15 years, you have to get your hands on the actual underlying assets and sell them so that you get the cash to finance the loss. Obviously, there's going to be a loss if a clearing member failed. When you run a clearinghouse and you've lost a clearing member, you probably don't want the market to know at that moment in time, one, that you've lost a clearing member. Number two, you probably don't want the market to know the kinds of collateral that you're going to sell in the next 90 days. If you think about that within the framework of the distributed ledger technology, the logical place to go sell, say, treasury securities would be to a big bank. Well, the big the big banks are also the largest clearing members, and they're on the distributed ledger. They would happily accept a digital image of the underlying asset. But if you do that, basically you're calling up one of the largest banks in the country and saying, number one, I just lost the firm, because otherwise a clearinghouse would never sell collateral unless you lost the firm. So, number one, you're telegraphing to the market, I lost the firm, and I'm gonna sell these kinds of assets. Probably don't want to liquidate the clearinghouse's collateral on the blockchain. And if secrecy is of considerable value, then the challenge is how do you liquidate the collateral without telling the market that you've lost a firm and what kind of collateral you're trying to sell. And the real challenge is that it's not universally accepted that the asset that a pension plan or an insurance company would be willing to purchase is a digital representation of the asset. They actually want to buy the underlying asset. The representative from the German exchange obviously had been working on this. It was implied that they had anticipated this challenge and that they had created some same-day redemption mechanism by which you could convert the digital asset to a hard asset. And we got the impression that it would happen on the same business day. That mechanism is going to have to be present for those few exceptions where every 10 or 15 years you're going to have a clearing member default. There has to be a mechanism where the clearinghouse has some kind of a redemption mechanism where you can trade the digital image of the asset for the actual asset, so you can deliver the asset to an insurance company or a pension plan and get it settled.